Hey guys, it's time for this month's market update. Our team just released the July data and market resources in the Forge to help you get caught up on the state of the markets as we head into the second half of the year. A few key highlights worth focusing on. Interest rates. Okay, so the Fed has officially begun signaling its intent to drop rates sooner rather than later. Their language has gone from all cards are still on the table in the spring to we're holding the line early summer to we don't need to wait to hit 2% before dropping rates. So a rate drop is just around the corner and most major banks are projecting the first 25 basis point reduction in September. The mortgage market has already reacted with 30-year rates dropping down to the high sixes. Now, as we discuss this with our clients, it's important to remember that there's little to no chance of these rates heading back to the ridiculously low levels that we saw like 3 or even 2%. More reasonable estimates are rates in the mid to low sixes by next year. Modest reductions, but impactful on affordability and consumer sentiment. There's no question that rates at 6.5% will drive buyer activity back into the market. Inventory has continued to climb, but at rates more in line with typical trends for this time of year. Active listings are currently up 39% over last year this time, but remain 32% lower than 2019 levels right before COVID. The increase is starting to be pretty visible in certain price ranges, and listings are beginning to sit longer and take price reductions. Last week, 38% of single-family listings reduced their price. Prices are officially softening, and that's good news. But keep in mind that, at least in Iowa, it is still a seller's market. Statewide, we're still under a 3-month supply overall, and in many price points, we're still seeing multiple offers on hot new listings that enter the market. There's no doubt that things have cooled, but that cooling is very connected to interest rates, with 7% seeming to be an inflection point for sentiment. It's going to be interesting to see what happens when the Fed actually begins its easing policy. I can imagine rates going down is going to increase buyer activity, potentially driving those prices back up. It really is an interesting and tricky market environment right now. We all want prices to stabilize, but we also want to see more sales. Interest rates are the key, but the minute they drop, we're likely to end up back in some kind of inflationary environment. The best case scenario is that prices soften enough that modest rate reductions drive buyers back into the market, but not at levels that recreate the frenzy of a few years ago. I guess we'll see. There's 2 additional unique factors to watch in this next quarter that are likely going to have an impact on the market. The first is the upcoming election this November. Now, elections have historically had some impact on market trends, and they typically pull down sales in the month leading into the election for no real reason other than people get kind of skittish. Consumers don't like uncertainty, and let's face it, our recent presidential elections have been pretty chaotic. The good news is that elections don't typically actually decrease sales, but they rather just delay them, and markets tend to pop right after elections are settled. So if you want more sales, hope for a smooth transition of power in January, regardless of who wins the election. The second force worth watching right now is actually the impact of the NAR settlement and then the implementation of all these new policies. Now, I don't have any firm data on this, but I suspect that there's going to be a measurable ripple effect from all the change and confusion to both agents and buyers in the market. Most buyers are totally unaccustomed to being asked to sign agency agreements up front, and some are being temporarily discouraged by this glitch in their plans. Obviously, this is just a short-term blip, but I do think it pushes some buyers back a few weeks as they shop around and then eventually realize that whoever they work with, they're going to need to sign some form of agency agreement. The bottom line is that change and instability have an unsettling impact on home sales, and there's a lot of change and chaos in our marketplaces right now. I think it's easy to see that our focus should be to act as steadying and anchoring forces in our customers' worlds by providing the facts, acting as expert advisors, and then guiding our clients towards action plans that actually get them where they're wanting to be. We get paid when we sell homes, but any great agent knows that that's not what we're being paid for. Stay the course, always take the high road, and put your people first. It's going to be an interesting 3rd and 4th quarter. Don't forget to download your local market stats, social graphics, and talking points at the Forge in the market updates section. You got this.